Good afternoon, everybody from Nairobi. We're continuing our series of Trading 101 with Lawrence Nderitu of EGM Securities. Lawrence, what are you going to teach us today?
Today we are going to talk about indices. Maybe kind of explain what indices are, kind of show what EGM has for index trading, and kind of maybe look at one or two indices and how they are created. So an index is kind of like a market capitalization. It's more of stocks that are put together. And then you create an index. So for example, in Kenya, we have the NSE 25. So it's 25 individual stocks that are piled together, maybe using a formula like maybe a weighted index, weighted average, and then you come up with this value for this one index, and then an investor can trade the whole index instead of choosing individual stocks. So that same concept is taken obviously into our markets, the CFDs markets, and we have several indices.
Which ones do you have?
So we have 15 of them. So the one here is AU 200. So if
Australia.
So if you just hover the mouse there, you can see there's Australia 200 index. So these are 200 stocks, and then you bring them together, you create an index.
Essentially, when you're buying an index, you're buying all the 100 stocks that make up that index.
Yes. So one thing about the index is this: it's going to be less volatile.
Yes.
That's maybe less risky for you because you're looking at a weighted average. So an individual stock may do very well, but another stock may do poorly, depending on if they're on different industries. So it kind of lowers your risk. So the index may not move by that much. It might actually lose when an individual stock, maybe in the same index, is gaining. You get why it's so obvious because they are.
So within the composition of the index, you've got winners, you've got losers, and that's netting out into the figure.
So it's for people who would want more stability as opposed to more volatility. So an index is going to be more stable. So if you look at the NSE 25, it's more stable depending on what you're looking at if you compare it with individual stocks. So today we're going to look at the UT 100, which is
UT 100 is the Nasdaq.
It's the Nasdaq.
It's somebody said to me that you told me. You said to me if you just bought this Nasdaq and kept on buying it on every pullback, you'd have made a fortune.
Yeah. So that's the monthly of the Nasdaq. It has obviously been on uptrend. But if I go to lower time frames, so here we're looking at some of the tech companies.
Yes.
So this has been it has been gaining. It actually hit.
Are all the FANG stocks in this? Facebook, Apple, Netflix, Google.
Yeah.
Okay.
So so it has been doing quite well actually. It hit its highest value.
Was that there?
79? Yeah. Yeah, that was that there. So it just retraced back, but I still the trend is still bullish. As you can see, it's still within the 21 moving average. Still on the upside, so it's still bullish. And remember that investor outlook for tech companies is still very, very high because I think there's so much to give in terms of tech. Yeah, so this is now the UT 100. So it's 100 stocks, tech stocks, and then they bring them together, and then you make one index. Another volatile one is a DE 30 or the German 30.
This is the DAX.
The DAX.
Yes. This is made up of all the top German companies.
Yeah, blue chip companies in Germany. So for this one, it's a bit volatile as it ranges a lot because it has pharmaceuticals, chemical companies,
car
manufacturers. So you find that when car manufacturing is doing very well, like the VW scandal, the diesel fuel thing.
Yes.
If it's doing, then you have other companies like maybe Pfizer that are doing well. So it kind of averages out. So like we are saying, it might not be as volatile as individual stocks. So it's mostly for
and what has this index been doing over the longer term?
Over the longer term, if I can just go to the weekly. So globally, the indices have been gaining, but you can see this one is not as
corrected.
Yeah, this is because it has more industry participants. It has a wider pool as opposed to the UT 100. It just got And also remember, this
manufacturing, global trade, all of that kind of thing.
Then we can look at one last one. The most famous one is the S&P 500.
Yes.
So on a longer term here.
So again, we're very close to an all-time high here still.
Yeah, we're very close to an all-time high.
And many people have said this is why Trump thinks he's winning his trade war, because if you put the Chinese chart up here and compared it, that is at a 4-year low.
Yeah. By the way, I think today, I read from Bloomberg that the Chinese stocks are doing very poorly.
Yes, 4-year lows.
Yeah, I'm not sure if it's because of the trade war thing. It might be. I might attribute it to that, but I'm not quick to jump on that. No, it might be the reason. Yeah.
So this is the S&P. This is the top, probably the best proxy for the U.S. economy.
For the U.S.
right?
economy, yeah.
So people who want to be bullish U.S. would buy this kind of index.
Yeah, they would look at these kind of gauge the market pulse and then maybe look to buy this index.
And basically, you're saying
you can do 15
you can
of them.
trade any of these indices with yourselves, basically get exposure to any of these markets in case you feel that you have a strong conviction about it.
Yeah, yeah. So there are 15 of them.
Yeah.
Obviously, moving from Europe, Australia, Hong Kong, yeah, and America. We have also the Dow Jones is there also.
Great.
Yeah, and also France.
Fantastic.
Okay, fantastic.
Thank you.
Thank you for your time.